Hi there folks, it's James Marley here, co-founder at Livewire Markets, and today I'm joined by Jacob Mitchell, who is the founder and chief investment officer of Antipodes Partners. Now Antipodes has been around about a decade, or it's just cracked through its 10-year anniversary, $20 billion in funds under management. We'll be speaking with Jacob today about a few lessons over that 10-year journey, and we'll also dig into a few of his current ideas. Jacob, thanks for coming in, good to see you.
James, great to be here.
Jacob, as I mentioned in my intro, 10 years of Antipodes. Could you give me a couple of lessons you picked up about investing globally over that time?
Yeah, sure. Look, it's been a pretty interesting environment. You've over that 10-year period, defined by US exceptionalism, the rise of passive, the rise of private markets, and in global, in managing portfolios with a pragmatic value style. I mean, your philosophy stays, very constant, but obviously the way you go about implementing that has to evolve. And I would say, across our team, we've definitely just worked very hard to make sure our fundamental bottom-up industry analysts have the most current toolkit in terms of technology to do their job, so they can be productive, hunt out those interesting opportunities in a really timely manner. Number two, with our quant and macro, we've definitely evolved. Given we run long-short strategies, we've evolved that toolkit just in terms of systematic quant, identifying, short baskets that we can create, more use of alternative data to manage position sizing risk in longs and shorts. And ultimately, I think what it means today is that on that 10-year journey, we've really evolved to a really nice synergy of bottom-up, top-down working together in a quantamental sort of fashion. It's been really exciting.
It's been a great bull market. Global equities have been hot. Australian equities have been good.
Yep.
What are some of your views on the sustainability of the run at the moment?
We definitely think the market the bull market is maturing. There's obviously a lot of concentration in the benchmark. If you think about where valuations were, if we focus on the US exceptionalism, 10 years ago, the US was on roughly 15 times, which is what the rest of the world was on.
Yep.
It's now on 24 times, and it's on a 30% premium to the rest of the world. And then the level of concentration in the S&P top 10 used to be 12%. We're now at about 30%. So a lot of benchmark return in ACWI is coming from US quality, mega cap, tech, AI enablers.
Yep.
I don't know how many more labels I can put in there, but that's a big part of the return. And that's what worries us, is really the way investors are thinking about the benchmark. Obviously there's this big focus on tracking error as the sole measure of risk, benchmark volatility,
Yep.
versus thinking about how much old-fashioned value at risk in the benchmark.
Yep.
And given how many portfolios have shifted to passive or to core, you really wonder whether investors are underappreciating, let's call it more diversified sources of alpha. Let's call it strategies that are more benchmark agnostic.
Yep.
Yeah.
Yep. Well, you don't really appreciate it until you need it, is what I would say.
That's right. That's right.
Now, Jacob, talk about positioning. You guys were relatively early, or at least a year or so ago, and moved to Europe.
Yep.
It's become a little bit more popular as a source of returns more recently. What was behind the move to Europe, and what's the thesis on that part of the world going forward?
Yeah, James, I wish we had have only moved there a year ago. I wish it had been that timely. We've been overweight that region for more than a year.
Right.
But it's certainly come into its own in terms of really good performance from Europe, but also our selection in Europe has been pretty consistent through time.
Yep.
But now in the last 12 months, we've actually had also that allocation benefit.
Right.
And that's not really what we were playing for in Europe, in the sense that we weren't in Europe from a top-down perspective. I think you'd have to be quite delusional to think that the European macro was going to give you a tailwind.
Yep.
So that was never our thinking. It was more that the bottom-up opportunity has looked very appealing in Europe for a number of years. Just looking at companies like Siemens Energy, Thales, these are all big winners in the last 12 months. When we were benchmarking their valuations against global peers, we were seeing discounts of up to, between 30 and 50%.
Yeah.
And it just didn't seem to be justified to us. And certainly, we think whilst we've tapered some of that exposure, and we're actually seeing a similar dynamic in Japan now, where some of those really well-positioned multinationals are looking quite cheap relative to global peers. We certainly still see more upside in Europe. And then where we have had some domestic macro exposure to Europe has been in financials. SocGen, NatWest, our insurance exposure in Score. And we still think these have more to offer, just because they started so cheap.
Yeah.
When we bought into SocGen, it was on a P of 3.5. It's now on a P of 5, and also estimates have gone up something like 40%. So the market was just really missing the bottom-up opportunity, and we're still getting like combination of dividend and buyback yields in most European financial. A lot of the European banks are still running at 12 to 15%.
Yeah.
So you're getting paid quite a lot just to sit and wait for the idiosyncratic case to play out.
Yeah. You said you were there for valuations, which look compelling, but the broader picture, there wasn't a really attractive macro factor to drive it.
Yeah.
That's changed a little bit recently because there's been a bit more coordination over in Europe, an incentive to get behind some spending and to think on their feet.
Yeah.
So does that carry it forward? I mean, does the picture of the valuations maybe picked up a little bit, but there is a catalyst for more activity over there?
Yeah, look, I think it will. It will take a little bit of time to get a lot of these spending programs, really firing. Whether it's what Germany's doing with its special borrowing program, where they're going to expand the fiscal deficit by a couple of percent and target a combination of defence and infrastructure. But you really are coming off a low base. So even though you might have to be patient for it to kick in, it's definitely have a powerful impact on future earnings and future multiples. Let's call it terminal growth rates, to the extent that Europe has fundamentally shifts to a looser fiscal policy framework. And that is we've always thought that's a free option in Europe versus in the US, where you could say that option was really banked along, quite some time ago, from Trump Mark 1, 2016 to today. Fiscal deficits in US have added a 60% to GDP, debt to GDP, right? So they've been equivalent of 60% of GDP. That's a big number, right? Let's call it in peacetime, with full employment, to be stimulating that aggressively. The US is truly exceptional, right? And now Europe did roughly half of that, so 30%, a much lower number, and their starting position on debt to GDP is lower, so they can go much harder. Yeah. They've kept their powder dry, and I think that's what we're seeing. Great way to play that would be a company like Thales, which is a French defence contractor, where roughly 50% of their revenues are coming from the sensors that you use across defence equipment. And if you think about these increases in defence spending, you're talking about percentages of GDP. A lot of that, today, there's not much spending on any equipment, right? Like you're basically maintaining very old kit. So the delta on equipment spend is going to be very, very large, because a lot of that new money, it's not going to go into people. Yep. It's going to go into kit. And that's you're talking about 3x, 4x the level of current new equipment procurement. So I think people are underestimating the impact for the defence contractors, and ones that are, like Thales, that are very well positioned to gain from the European spend.
You've talked a little bit about US exceptionalism and concentration. What would it take you to get excited about investing in the US? I mean, there's still fireworks going off over there. We've just seen Oracle have a massive move overnight.
Yeah.
What does your US allocation look like? And what does it take for you to start putting more money to work over there?
Yeah, look, it's like just to straight off the bat, I mean, the US productivity growth in the US over the last 10 years has been running about 50 basis points higher than the OECD average. So, we're going to, acknowledge that. We're not blind to that. And we also know that the US corporates have led some of the big innovation breakthroughs in terms of transformer, large language models, led by Alphabet. Look, we would say it's we have a very healthy exposure to the US. Off the bat, whilst we're underweight, we're not as underweight as what it looks like from a domicile perspective. A lot of what we own in Europe actually is a multinational. It's a cheap way of getting exposure to the US. Yeah. But directly, let's talk about the US into two buckets or three buckets. I think you've got, let's call it
7 stocks.
You've got the 7, and then you've got outside that 7, you've also got a bucket of other quality companies that are non-tech. Now they're growing at 6% per annum, and they're on P's of, let's call it 24 times, 25 times. Yeah. Whereas the tech stocks are, arguably not that different in terms of P's. You've got Alphabet at the low end, 20. You got Microsoft and Apple, Nvidia at around just over the 30 mark.
Yep.
So in a way, the average is sort of not that different, but they're growing at 15% versus 6.
Yep.
So we would say in that second bucket, quality X-Tech, you've actually probably got more valuation creep, if you like, than the tech bucket,
the
number one.
Leaders.
Yeah.
Yep.
So and then you've got everything else outside of quality. And value is interesting, right? As a factor, when we do our analysis, it's on half of the multiple of quality, but it's only growing 1 percentage point more slowly. It's growing at about 5. Those companies in the bottom quintile that just so happen to be low multiple, the scourge of being low multiple, they're growing at about 5 versus the quality X-Tech, which is on double the multiple, growing at 6. Yeah. So look, we think there's a case to be tilted to value, and naturally we think there's a very strong case to be tilted towards pragmatic value.
Yep, you've mentioned that a few times.
Yeah.
I'm familiar with the term. Maybe just give us the quick definition on pragmatic value.
Look, it's not rocket science. It's paying the right multiple relative to your level of growth. And thinking about the package that it's coming in, the business resilience, and we're happy to invest across the spectrum, right, from low growth to high growth. In terms of business quality, look, there's very few very high quality companies. Now, if they fall out of favour, like Alphabet did recently, we're all in. Yeah. But we're also happy in the middle. Well, it's a normal distribution. There's a lot of companies in the average. Yep. We'll go a little bit to the left into lower quality, but there's a point where we say, hang on, the margin of error starts to really rise exponentially. And so it's paying the right multiple versus growth and underlying business resilience, as opposed to being an investor that's driven by an attribute, which is I only own high growth or high quality.
Yep. Yeah. You mentioned Alphabet there.
Yeah.
You own it. One of the Mag 7 that you do own. Are there any others, or is that your sole play?
Oh, look, definitely. We have a very active position in Alphabet, a very active position in Amazon, but where we are underweight Microsoft, and we don't own any of the others. Yeah. And look, the case, for Alphabet, look, only 3 months ago, it was on a 1-year forward P of 16 times. It was on a discount to ACWI, on big discount to S&P, more, 35% discount to S&P. And why? Because investors are worried that the rise of chatbots and OpenAI, ChatGPT-4 and others are just taking eyeballs away from traditional search. Now, number one, Alphabet has maintained 85% of the market. It's the sorts of things that are being done on ChatGPT-4 tend to be much more research-intensive style projects, as opposed to where can I find the closest dry cleaner. And so commercial search queries at Alphabet is still growing. I think investors also overlook the fact that this is the OG AI company. It's the only company that has all three elements of the tech stack, from proprietary hardware, where they use no NVIDIA chips for training or inference, all done on their own custom silicon ASICs, which we think gives them a cost advantage. Number two, they have the biggest and best, arguably best, large language model and some of the best data and real-time data to train on. And number three, they have the application layer. We've got not only the sorts of applications we see like search and Gmail, Maps, but things that are coming like Notebook LM, really breakthrough technologies. And
YouTube, massive streaming service.
YouTube, and then on top of that, you've got this little business called Waymo, which, if you take the Tesla market cap, could be worth, a lazy, 800 billion. So look, there are multiple ways, in Antipodes parlance, multiple ways of winning. And even though it's gone up a bit and it's on 20 times, it's still at a discount to the S&P. And we think it's growing pretty sustainably at about 15% per annum.
Alrighty, let's go from a bullish discussion. What's the risk? What's keeping you up? What do you think people are missing?
Look, I think from our perspective, probably two issues that we would be stress testing the portfolios around, long, short, long only. All our portfolios would be stress testing them around just either some sort of dislocation in the sovereign, in the long end of the bond market. You see bond yields rising across many jurisdictions, not just in Japan. Obviously, UK is always very topical. US comes and goes. But just given the amount of debt that was taken on by sovereigns, coming even before COVID in the case of the US, but then definitely in COVID and still happening, fiscal sustainability will be very sensitive to GDP growth. Right? Because without the growth, it gets harder for bond markets to accept that the debt's going to get repaid. Secondly, it's private credit, and not, when we talk about private credit, we do it through a global lens. And what we see in the US and in a smaller scale in Europe is very different to what we see here in Australia. Like, private credit is really replacing the absolute bottom tier of the junk bond market. It is, the average lend is 6.5 times debt to EBITDA. Right now, at an interest rate of 11%, which is what these guys pay, it's a variable rate, and they've been paying that now for three odd years. Since inflation took off and policy rates had to go up. You have to think some of these corporates who are very much cash flow negative in many cases, are stressed. But you also have to think there's a bit of an extend and pretend game going on because of the inflow to the asset class, right? Like private credit inflows. The pool of private credit in the US has grown at 20% per annum for the last 5 years. So it's all fine until the music stops. And what worries us is this looks a lot like we saw in the mortgage market in the years leading up to the global financial crisis. It wasn't the average mortgage borrower that was the problem. Same thing today. If you look at the S&P 500, corporate credit is rudely healthy. It's the bottom 20% in 2007 20% who should never have had a mortgage. And it's the same thing today. It's not the S&P 500 borrower. It's the Russell 2000. It's the small cap, mid cap borrower, and it's the private market borrower. So private credit. Private credit lends a lot to private equity, and look, we think that's where the stress is. So if we move into an environment where inflow becomes outflow, that's when the stress starts to, that's when the extend and pretend game gets harder. And that's where we would think, what worries us is you get a self-reinforcing cycle, because we think the scale of this today we would estimate that in the US, roughly 20% of the workforce is employed by a very leveraged corporate. So we're already in a fairly precarious employment market. It's much more balanced. Unemployment's going to be much more sensitive to a fall off in job demand. So you can get that classic recession, self-reinforcing cycle, and that becomes a credit crisis in private credit pretty quickly. So that is the big tail risk that we see today. We want to obviously protect on the long side. If we see a recession, it's not our base case, by the way, but if it becomes the base case, we would certainly move all our portfolios to a much more defensive posture.
Yep. Just very briefly, 2007, 8, mortgage stress was the start of it.
Yep.
Flew through to all markets, public traded equities, that sort of stuff.
Yep.
Does the private equity scenario, do you think that has a similar flow-on and knock-on effect to all asset classes?
Look, it has to, right? Because it's in all institutional portfolios, and arguably the Fed has always been pretty creative in the way that it's responded to these types of crises, right? And we're not denying that. The cavalry will arrive.
Their creativity has been adopted by many, I would say. It's become the way to do business.
Yeah. Yes. And look, we would expect the same thing to happen, but I don't know. You have to get to that point of stress, and there's a lot of pressure on the Fed to be less interventionist. And also, you've got this little thing called inflation, which is, who knows? It looks like it's under control, but with looser monetary policy, that could become more of an issue as well, right? Services inflation has remained pretty sticky. So policy flexibility arguably is not as great as it was. And, we would say, look, we're very mindful that listed assets tend to become, when portfolios are under stress,
they will go to the liquidity. That's what they take.
You become the ATM, right? Yeah. So we know how this plays out.
Okay, I can't let us finish up on a bearish note, but we do need to finish up quickly. So we'll come up with a couple of stock ideas. Give us a name that you think the market's overlooking at the moment.
Look, I'll do it quickly. Give you two names.
Yep. That sounds great.
I've spoken about Alphabet. Look, I think in that bucket as well, the elevator pitch for AMD, which is the number 2 player in both CPUs and GPUs, we think it's a company that's come a long way. I mean, they made a really bold decision some years ago to outsource their manufacturing to TSMC, and they competed against Intel and CPUs, and thank goodness they did that, because we can see what's happened to Intel. But they've gained 30% market share in CPUs and become a very credible second provider to data centers and to consumer applications. They made a decision they ought to invest also in other things like GPUs, and so they are also very arguably in training very competitive with NVIDIA on GPUs for inference.
Yep.
And they're winning across all the hyperscalers outside of Alphabet, who doesn't use any GPUs.
They do their own,
and the only one they haven't cracked yet is Amazon, and we think that's likely. They're used by all of the mega cap tech stocks, the big ag companies. So they're very much, we think they can get at least 10% of the market. Now, I'll give you the number. NVIDIA's got a $4 trillion market cap. AMD's got $250 billion in market cap. They do not need to get much GPU market share to make this a very cheap equity.
Yeah.
Okay. Number 2, in the US, we've been active in the credit card company, the auto finance space. Capital One, we've spoken about a lot previously. Ally Financial is a lender in both the new car market and the second-hand car market. We think it's really interesting. Just as a business, they've done really well, similar to Capital One, building a digital bank. So raising deposits in the online market, and they have a really great franchise in terms of pricing risk. And so it's one of those equities that benefits from steepening in the yield curve, and we think rate cuts are coming.
Yep.
as that yield curve steepens and their auto loans roll onto higher rates, you'll get expansion in net interest margin. At the same time, that outside of a really steep recession, their credit costs are coming down. The credit costs are coming down because, similar to Capital One, both companies expanded their books pretty aggressively coming out of COVID. So they've already had a credit cycle, if you like. They've had the pre-recession recession.
Yep.
So we think the earnings are, there's a lot of, let's call it, there's a lot of sort of margin of error, if you like, in the earnings. Or the earnings are well buffered, if you think, from potential. So credit can improve at the same time that margins expand. And look, you're paying a forward multiple of around 6 times, and we think earnings are way too low. Like realized earnings will be much higher than estimates. Yep. Yeah. So that's, I think, another way. We have that in a cluster of opportunities that we're seeing in the US, in parts of the market like autos and housing, where you actually have had a rationing of demand because of higher rates. Yep. They're the parts of the market that will benefit from rate cuts. Yeah.
Great. Well, Jacob, always good to catch up. Thanks so much for coming in and spending some time with us today.
Excellent. Thanks, James. Great to be here.
Ladies and gentlemen, I hope you enjoyed that chat with Jacob Mitchell, the founder and chief investment officer of Antipodes Partners. Remember, check out our YouTube channel. We're adding fresh content like this every week.